All right, everybody, welcome back to our latest installment of the Million Dollar Question. I'm Stephen Weitzel, managing partner here at Reveille Wealth Management. And today we are going to be going over the monthly review or a portion of the monthly review that we do with our clients just to help set the stage of what's going on, what are the trends in the market, and making sure that we are aligned with those trends. A lot of changes happening here in early 2026. And I'm concerned that a lot of people are off sides right now. We had my friend Larry McDonald on the show a couple weeks ago, and we kind of had a conversation about people investing in the rearview mirror, and that yesterday's winners are not likely to be tomorrow's winners, and where this market is going to follow a completely different path from what we've seen over the last 10, 12 years. And a lot of folks have grown accustomed to market leadership being concentrated in one area, and times be changing. So we're going to be talking about that today. As we get started, I will tell you that it is birthday season in my family. So my youngest daughter had a birthday at the end of January. Today happens to be my sister's birthday. So happy birthday, Steph. Hope you have a great day. She is older than me, and I will remind her that every opportunity that I get. But happy birthday to her. Tomorrow is my wife Courtney's birthday, a milestone birthday for her. I'm not going to tell you which one, but for her birthday, she wanted to see the Backstreet Boys in Las Vegas. So we are wheels up early tomorrow morning from Atlanta out to Las Vegas to go see the Backstreet Boys at the Sphere. So happy birthday to her. Looking forward to that. So let's jump in. We're probably going to have another Backstreet Boys reference sometime in our discussion today, but we're going to begin with this review. And so some of the main things that we're going to cover here, and we did not get a Santa Claus rally, but despite his absence, the market started off very strong. We're seeing a lot of rotation away from the former leaders in this market. And not only is that rotation happening, it is accelerating. The concentration risk in the U.S. market, in the large cap indices, continues to be a real headwind for the S&P, for the NASDAQ, and for the passive overdose that really dominates the way that so many investors are exposed and positioned in the market today. That is a problem. The private credit issues that are out there, they keep coming. I fear that they're going to get worse, and they could potentially be the powder keg for this market environment. We got to keep an eye on them. And then we got Kevin Warsh finally nominated by President Trump to succeed Jerome Powell as Fed chair. We're going to talk about the potential implications there. So we're going to set the stage here. Big picture, we talked about this in our review in December, so the beginning of January. We looked at this exact same chart, and it is a word of caution, really, and it being the concentration risk that underlies these large U.S. indexes today. So we said the S&P 500 has never been less diversified than it is right now, where you've got 40% of the index is comprised by the 10 largest names, and that is substantially higher than what we've experienced by historical standards. Even when the market was peaking in 2000, you had maybe 25% of the index comprised by the 10 largest names, not 40. But in kind of a similar vein to what we experienced maybe back at the peak of the dot-com bubble, you've got 8 of the 10 largest stocks in the index are technology names. And that technology cohort, and I mean, some people are going to argue, well, you've got some communications in there. Yeah, that's been stripped out. That used to be part of the technology sector. But for all intents and purposes, these are tech names. But you've got 8 of the 10 largest names that are in the growth cohort. And then the other 2 are financials, JP Morgan and Berkshire Hathaway, that are in that value classification. But that means that the growth names have dominated. That's what's been carrying the water for the U.S. indexes. And, you know, over the long haul, right, you talk about things like stocks for the long run. And when Harry Markowitz was doing his modern portfolio theory, he was saying over time, stocks are going to have effectively the same return. It doesn't matter if they're growth or value, or if it was JP Morgan or Exxon Mobil or whatever. And maybe over the very long term, maybe he's right. But there are cycles where certain stocks outperform their counterparts, where growth stocks outperform value stocks and vice versa. And that level of outperformance or underperformance, a lot of times it's quite meaningful. So here we're looking at the historical ratio of the Russell 1000 growth relative to the Russell 1000 value. And so if we set the stage, we're going to go back to, really right before this chart would have incepted, from the mid 1990s through the early part of the year 2000, as the tech bubble was bursting. That was the last time that we saw really substantial underperformance from value, outperformance from growth. And then as that unwound, as the tech bubble was bursting and this ratio was pulling down, this is the outperformance of value stocks, the underperformance of growth stocks. But really, since after the financial crisis, or leading into the financial crisis, when the value names, energy, financials being some of the largest cohorts there, industrials, but you got things like consumer staples that are part of that mix as well, that those things were dominating. And that's what investors really clamored to own back then. People wanted to own energy. They wanted to own financials going into that time period because, surprise, surprise, that's what was working. And that's what was leading. And that's where a lot of people got caught off sides. The exposure in energy and financials was some of the highest weightings in the S&P 500 index that it had been in a very long time at that peak. And so that is where the perils of indexing can harm investors. You end up overexposed to the areas that are the most expensive and perhaps the most susceptible to decline. But really, since that period, post-financial crisis, we have been in a period where the growth stocks have been outperforming value, perhaps one of the longest periods of outperformance in history. There have been a couple of interruptions along the way, no doubt. But I don't know if we've ever seen such a pronounced, protracted period of outperformance of one classification of stocks over the other, growth outperforming value, right? But that brings us to where we are today, that this ratio between growth and value, and we talked about it last month, it was hitting this 161 extension and likely to encounter some resistance. And boy, has it ever. It has seemingly failed and put in a failed breakout at this level and is pulling back pretty rapidly here. And not only are we seeing that rotation in the market, but this is the risk to the market, right? Here is the concern. If the largest components of the U.S. stock market are comprised almost entirely by these growth stocks, right? And these companies, they make up more of the index than they ever have before. And these cohorts of stocks, they're starting to underperform. What should we be preparing ourselves for? Well, I want us to look at the last couple of times when we've seen meaningful pullbacks in this ratio. The dot-com bubble, or the aftermath of the dot-com bubble, and then 2022 were both periods where we had some pronounced declines in this ratio. Those were not bullish market environments, okay? That was not a strong period of time for the indexes on their own. And so what I would say is that investors right now, you need to be guarded. You need to be guarded because this is where the risk lies in the market right now. And if we continue to see this ratio pull back, it may not mean great things for the market as a whole. All right. Here's the other piece. And we're kind of building a case against the S&P 500. All right. We're contemplating that. So when we see asset classes start to struggle, we tend to see them struggle against a number of their alternatives. So should we be surprised then when we see the S&P 500 or the NASDAQ? If we had the NASDAQ up here, these charts would look almost identical. So these indexes, they're highly concentrated in these tech names, in these growth names, and they're at some of the highest valuation levels that we've seen on a historical basis. Should we be surprised to see them starting to underperform a growing number of alternative asset classes? I don't think so. I don't think we should be. And I think the bigger surprise, when they write the book on this cycle, we're going to look back and we're potentially going to say, I'm kind of surprised that it went on for as long as it did. Okay. I want to talk about this private credit situation with these frothy valuations, and concerns around the sustainability of this AI build out, which we've been talking about at length here for a number of months. And if you've missed it, we've talked about it on our YouTube channel. You can go to the Reveille YouTube channel, subscribe there, turn on your notifications so you get alerts as soon as we have things posted there. But this private credit market, right, is potentially the most underappreciated risk in this market. So we talked about it on one of our last podcasts, are we in an AI bubble? So I want to just kind of set the stage that a lot of the lending that is happening here in these private credit markets, this is lending that formerly would have taken place in the bank. And I think it is analogous to a lot of the lending that took place in the mortgage space pre-financial crisis, where there are lax underwriting standards. But post-financial crisis, there's a lot of regulation that gets imposed on the banks. They are really precluded from doing a lot of this type of lending now. This would have been considered mezzanine finance back in the day, where you'd go up to the mezzanine level of the bank branch, you talk to the president or something like that, and they'll give you various terms on some sort of unconventional lending. Well, because the regulation pushed a lot of this lending out of the banks and it went into the private markets, now you've got companies out there like Blue Owl, KKR, Blackstone, Apollo, that they are gathering money from investors, and they are taking that money and they are lending it into a number of different projects. A lot of them in the last several years has been related to this AI build out, data center stuff. And the issue is they're taking this money from investors and they're obligated to deploy it. They've got to go and deploy it. And I believe that they are being, they're not as focused on the credit worthiness of some of these projects because they know they've got to get this money to work for their investors. And so Apollo, so this story crosses the Bloomberg wires in late January. that Apollo, they took a loss, $170 million on a $500 million investment that they had made, right? This was private credit. And the thing that was really eye-popping as it came across the wire is that this $500 million investment that they were making was deemed safe. And they took a 34% loss. They took a 34% loss on this. And so I worry that there are tens of billions of dollars of masked losses that are currently out there in these private credit markets, right? A lot of the money's been used for this AI build out, as we've talked about. And my worry is that there are people who never really contemplated that they were placing their capital at a reasonable risk of loss, and that very well could happen, very well could unfold, and that these are the types of things that happen when bad situations become a lot worse. So if you are currently invested in these private credit funds, I would tread very cautiously. Believe none of what you hear, only half of what you see, because as our friend Larry McDonald likes to say, the truth, it bleeds out very slowly. Okay. So we're at the onset of year 2 of the 4-year presidential cycle. And this cycle historically is the choppiest of the 4 years. So now we still do need to recall that from a seasonality perspective, that we are in the middle of the most bullish 6 months of the year. From November through the end of April, that's the most bullish 6 months of the year. And then you sell in May and you go away. In that historical analog, it actually tracks really well for this year, right? We can see that the analog, right, the blue line here would suggest that the markets would maybe go up into about that May timeframe, and then all the way through the summer and the early fall. This is, historically a pretty volatile time. But from the fall of the midterm year through the summer of next year is the strongest part of the entire cycle. That's kind of the carrot out there. So we need to come in with an expectation that the market should be more volatile, or very well could be more volatile this year. But importantly, we can never blindly trust these analogs or seasonal trends. We can't blindly trust any of them. We need to align with actual trends in the market. And so let's file that away in our mind. And that's really the discussion today. So let's move on, and we're going to look at some of these indexes here. We're going to start with the S&P 500 index. It is in an uptrend. All right. Ever since May of last year, it re-entered an uptrend and has been pretty steady, climbing higher. S&P was up 1.37% in the month of January. Not bad, although it did lag a lot of its counterparts, a lot of its alternatives. And so, again, we've kind of been building the bear case for the S&P about where the risks are right now in the market. And the real concern here is that if the S&P is going to turn into a laggard, and it's going to underperform a lot of its other alternatives, that historically, when you see that, an asset class that is underperforming the preponderance of its alternatives, that it can actually do poorly on an absolute basis as well. And so that's kind of what we're seeing so far here in 2026. Nobody really wants to talk about it, but the S&P and the NASDAQ are some of the only indexes that are in the red for the year. For a lot of other areas of the market, it is like a banner start. It's one of the best beginnings to a year that I think I've ever seen in my career, as far as how things like small caps, international, emerging markets, commodities have traded. The NASDAQ, the S&P, the technology names, not so much. Okay. Not so much. Mid caps, the Jan Brady's of the world, as JC likes to say, still in an uptrend, had a strong January, up over 4% in January for the mid caps. But here's what's important. We are now back above these former highs from November of 2024. So you had this post-election rally in the mid caps, and then nothing. You stalled, you went sideways for over a year, made no progress, but we are finally breaking out and eclipsing those former highs. That is a welcome sign for the bulls. We want to see that stick. We want to stay above these former highs. If we can't, it is going to be potentially problematic. Small caps, Russell 2000 index, also in an uptrend, very strong January, up nearly 5.5% in January for the Russell 2000 index. But that is after 4+ years of no progress, right? So you had the Russell 2000 peak in October of 2021 and go nowhere, nulle part, as the French would say. No progress whatsoever in the Russell 2000 index until December of last year. We were finally able to get above it, and now the breakout is potentially on. We want to see the Russell 2000 again hold above those former highs, but that breakout is material. So when we look at small caps on a relative basis and we talk about them becoming leaders, we're seeing them find support relative to the S&P 500 at a logical level. It's essentially the same place that they bottomed 25, 26 years ago against the S&P at the peak of the dot-com bubble. So is it a coincidence that they've just started to outperform at these levels? I'd say no, right? We talked about the potential for why this could be happening here. Why are small caps starting to outperform? We talked about it a little bit last month in our review. We talked about it in some of our podcasts. And, one of the parallels that we drew to the dot-com bubble, to the internet, the internet renaissance, is that when that technology was new, the internet was new, that it was very expensive. And only the largest companies could afford to buy it, implement it into their businesses. And so maybe that was the reason why the large cap stocks were outperforming small caps by such a large margin from the mid-90s to 2000. But as that technology became cheaper, as the technology they found could face obsolescence, and it was all of a sudden at a price point where any business could afford it. They may be buying technology that's a few years old, but now even small businesses could afford to buy this technology by 2000, 2001, 2002, and they could implement it into their process, and they could now be benefactors of this technology. Now, they may not be going from 0 to 100. They may not be buying the latest and greatest, but going from 0 to even 25 or 30 miles an hour is a big deal. And I kind of wonder if we're going to experience the same thing with this AI technology. Even though we are skeptical about the implementation of AI, and that if it gets built out to the level that the market had been pricing in, the technology, we believe it is here to stay. We have no idea how it is going to become an integral part of our daily lives, in the same way that we couldn't really appreciate that 25, 30 years ago about what the internet would become. The same thing will happen with AI. But some of those leading companies that brought us the internet 25, 30 years ago, they're not here anymore. That could be the same case with the AI names, but the small companies, right now that some of that AI is facing obsolescence and it's becoming cheaper to implement and they can benefit from it and it's going to help their business. Maybe is that why we're starting to see a repeat of some outperformance from the small caps here at the same level that they bottomed at 25 years ago? Interesting. There's an interesting question, rhetorical question, right? The second piece, and this is kind of a chicken or the egg type thing, right? We've got the small cap index, the Russell 2000. It is breaking out of a 4-year plus long base. And so there's now technical support for money to go into the small cap stocks. Is that what's driving it? Or is it that money is coming in to small cap stocks because they are as cheap today as they were 25, 26 years ago relative to the S&P when they bottomed, right? I don't know. I don't know why, right? So this is going to see the Backstreet Boys. Tell me why. Here's the good news, guys. It doesn't matter why. It doesn't matter why. We don't make any more money if we know exactly why it is happening. The only thing that matters is that we have identified that the trend in small cap U.S. stocks is up, and you need to get on board. You need to make sure that you have them in your portfolio. All right, let's move on. International stocks. It has been an incredible ride for the developed international stocks. One of the strongest advances that we've seen in many years. And but until the spring of last year, no progress for the developed international index since October of 2007. They'd spent 18 years going nowhere, but we got this historic breakout last spring, and the train just left the station. It really never looked back. Up over 5% in the month of January alone. So very strong performance out of the international markets. Continue to see rotation there. Emerging markets off to a very strong year here in 2025. Remember the tariffs? You remember the trade war? And when everybody was super concerned about that, I don't hear a whole lot about that anymore. They're not trying to scare people out of their international positions anymore. So this one, unlike what we saw from the Russell 2000, what we saw from the developed international index that had already broken out, this one had not broken out yet. It was still below those 2007 highs until January. But now this one has broken out. I don't think that we can appreciate enough what this means. Okay? So again, the $1 million question is this one going to follow the same path as what we just saw for developed international, where the train just leaves the station? It never even comes back to retest those highs. It just keeps pulling away. Nobody knows. Okay. But the only thing that we do know is that this asset class is in an uptrend, and investors, you need to align yourselves with this trend. REITs, not a whole lot going on here. This is probably the quietest portion of the market right now, just kind of trendless. And maybe it's starting to hook higher just a little bit, but not a whole lot going on in the REIT space. Some good dividend yield available there, and so there's potentially some good opportunity there for some value, but not a whole lot going on in the REIT space. Let's take a look at the bond market here for just a second, and then we're going to wrap up by looking at commodities. So, bonds have just kind of continued to grind higher here. It's been a decent environment for bonds where you would have wanted them in your portfolio. And now we just kind of have to wonder, does 2026 have a big move in store for bonds? So we just got Kevin Warsh nominated by the Trump administration to succeed Jerome Powell as Fed chair. And there are a lot of people who have been speculating that the Trump administration, they're looking for a yes man to come and take over as chairman of the Federal Reserve, and that person is just going to lower interest rates indiscriminately from the jump. I'm not convinced that that's going to happen. And I'll tell you why. The yield on the 12-month Treasury bill and the yield on the 2-year U.S. Treasury note are some of the best predictors of future Fed policy that we have. And we don't have to read any minutes. We don't have to listen to anybody's conjecture about what they think about inflation or what they think about economic growth or currency. We can just look at what are the yields on the front end of the front end of the Treasury curve. That is a very a very good indicator of where Fed funds rates are probably going. I'll remind you that the yield on the 12-month bill and the 2-year Treasury note, they effectively got to 3.5% in September of 2024. That was when the Fed lowered rates for the first of 6 times. And they are virtually unchanged in that period. Since that period of time, since September of 2024, the yield on the front end of the U.S. Treasury curve, it has not come down much. The bond market was already there before the Fed started cutting. Now, the long end of the curve, yields are actually up by 0.5% or more since the Fed started cutting rates, and they've cut 6 times. They've already cut 6 times, and the yield on longer-term rates has moved higher. So my concern here is that Mr. Warsh, that he's going to be kind of hamstrung in any desires that he has to keep interest rates low. So I do want to remind you, this isn't his first rodeo. He's been on the FOMC before. Now, he wasn't the chairman, but he was part of the Open Market Committee from 2006 to 2011. And he was pretty hawkish back then. He would dissent in favor of not lowering rates. So he's not a dove. Don't expect him to come in and just take rates to the floor. I don't think that's who we're dealing with. And I think that's why the bond market has effectively been telling us you don't need to expect much in the way of imminent reductions in Fed funds rates. I just don't think it's in the cards right now. Now, we want to be watching that 12-month bill and the 2-year Treasury note yield. And if they start to break under 3.5, if they get towards 3.25, then okay, maybe we got another rate cut coming. But until that happens, I wouldn't expect it, right? But what I'll be interested to see is, will the Fed with Kevin Warsh coming in, will they have policies that are directed at trying to bring these longer-term interest rates back down? So I don't know if that's QE or whatever it is, but if we got longer-term interest rates down, that is going to have more of an impact on the real economy. We're going to see mortgage rates come down. We'll see small business loans come down, those sorts of things. That's going to be more impactful, okay? But this is the fly in the ointment right here. This is the fly in the ointment for people who think that the Fed can lower rates. And it's this big breakout that we've just recently had in commodities. So, the commodities index, it soared into the middle of 2022. After the COVID lows, commodities went on one of their greatest runs that I've ever seen in my career, perhaps the greatest run that I've ever seen in my career. But they fell back. And ironically, the peak in this index right here, this is when the whole Russia-Ukraine thing got started. Oil prices spiked back to 120, thought, we're going to 150, 200 again. That was the climax, right? Commodities peaked in the summer of 2022 and fell rather precipitously. Spent the next 3 years or so not going anywhere, just in a sideways grind. But they've been in an uptrend really since going into the fourth quarter of last year, And as soon as they took out these former highs that have been the top of that range that they were trapped in for several years, they just took off. They just took off. And this is happening, guys, without the largest component of the Bloomberg Commodity Index really working. Right? We know that silver and gold have been on a tear until recently. Way too much hot money coming into that space, and folks are recognizing that, oh, these things too are risk assets. But energy, which is the largest component of the Bloomberg Commodities Index, it still really hasn't even started going. Crude oil's mid 60s, right? It's down some today with news that the U.S. and Iran are negotiating. And so if the tensions in the Middle East are coming in, then maybe we don't need that risk premium in the energy patch, right? But all this to say that if commodity prices continue to advance, this uptrend continues, then that is a tailwind for inflation. That's a tailwind for inflation. And that is a headwind to any hopes that we're going to see interest rates come down materially anytime soon, right? Last thing I'm going to say here, there was a study that was recently put out by one of the big banks, and they were just looking at investor positioning based on fund flows. And they have arrived at the fact that investors have the least amount of exposure that they have ever had to commodities right now in their portfolio. They have never been less exposed to commodities than they are right now. That percentage allocation peaked in 2011 when commodities were super hot, right? Gold and silver were peaking at that point in time. Oil was back up and it was really moving. But investors are way under allocated to commodities. I would venture to say that most people don't own them at all. But we here at Reveille, we are firm believers in having a disciplined asset allocation. And so not only are exposures to commodities important as part of your portfolio, based on the fact that they're in an uptrend, in a pretty strong uptrend right now, and starting to outperform some alternatives like the S&P 500, they are warranted. Not just important, but warranted. All right, let's recap here. Strong start for 2026. Gains are broadening out. There's more dispersion. That is an opportunity for the areas that have underperformed. So whether it's value, whether it's international, whether it's small caps, it's a lot of the stuff that most people don't own because they still have their portfolio position for what did well over the last number of years. If you're going into your 401k and you're making allocations for where you want your money invested, and you're making that choice, looking at what this fund did over the last 1 year, 3 year, 5 year, and you're saying whatever the biggest number is in that category, and it's been the consistent, leader, you're doing it wrong. And I fear that you are going to put yourself in harm's way because this rotation is happening right now. The Mag 7 stocks are unch since October, right? All that leadership that people want to have in their portfolio, it hasn't gone anywhere. And right now, I hear people making excuses for some of these companies. I hear them say, well, their guidance has been so good. They reported earnings and they blew it out of the park, but the stock's still trading down. That doesn't make sense, right? The market doesn't know what it's doing. Let me tell you, the market knows a lot more than you and I do. There is an information asymmetry out here, and we need to respect the fact that the market can invalidate what our thesis is. I can tell you I've had plenty of really bad experiences thinking that I knew better than what the market did. So if the market is invalidating our thesis, if a stock cannot go up on good news, it ain't going up. Even if it has been going up for a long time, guess what? A lot of goodwill has been imputed into that area of the market. It ain't going to last forever. We talked about that before. Trees don't grow to the sky, guys. So if these big names, they're not performing in what has been a really strong market since Q4 of last year, in the start of 2026, it has been as robust as I have ever seen. But the former leaders, they're in the red. That isn't a good sign. It's not a good sign for them. It's probably not a good sign for the index as a whole. Private credit, this is the potential powder keg for the real economy. If we start to see more, or if we start to see some defaults, if we see some reneging, we start to see more losses that are taking place here, it is a real risk. And we still can't appreciate the amount of leverage that is in that space. And so these are the things that are concerning. These are the things that make me worry that there is a new bear market ahead of us, at least for some of the large areas of the U.S. indexes, that things have shifted. Okay. Lastly, we got a new Fed chair who's going to be coming in, but don't think that we're going to see interest rates just hit the floor. I don't think that is the case. I think the bond market has been telling us that inflation can still be a problem. If we see commodities sustain this breakout, move higher, that's a headwind to the ability to lower rates. And so make sure that even for your fixed income exposure, right? If 2022 taught you anything, it should be that merely having exposure to bonds in your portfolio is not a sufficient condition for managing risk. Diversification and asset allocation are important, but they are not sufficient to be able to protect you in a bear market when we find out that the bear market can happen to the bonds too. You can have both sides of the ledger sinking at the same time. So be prepared to manage risk even for your fixed income exposures, right? Everything right now is pretty rosy, I have to say, if you're in the right areas, if you're in the value names, if you're in small cap, mid cap, international, emerging markets, commodities, right? Even most of the fixed income stuff right now is pretty good. But you've got to be guarded because there are some real risks in this market right now. And we always have to remember that cash too can be a position. Maybe we end up back there at some point in time. Not right now. This is a strong market. Make sure that you are diversified, allocated into the areas that are performing. And that may mean that you need to reallocate away from the stuff that you have been in. Okay, that's it for the review here this month. Listen, if you want this deck, if you want the slides for this month's review, send us an email, info@reveillewealth.com. We'll send it over to you. If you want the full client version, because this review, it continues for our clients where we get into these are the actual positions that we hold in our model strategies. If you want that, you're going to need to call, have a conversation with us. But look, it has been a great start so far to 2026. Feel very fortunate, very blessed. Thank you all for tuning in for this latest installment of Bugle Notes. We will see you next Thursday, same time, same channel. Thanks for tuning in. I'm Stephen Weitzel. See you next time.